Rideshare has been a surprisingly robust business model lately as consumers have absorbed price increases willingly. Companies like Uber and Lyft are benefiting as a result. So in this video, I'm going to review Lyft and answer if I think investors should buy Lyft stock at current valuations. So let's take a look at this ride-sharing business.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so in its latest quarter, the company management saying that they continue to see demand for our platform increase, and our Q1 results reflect this. We delivered strong top-line growth and had our second consecutive quarter of positive free cash flow. And the trend for the industry has been positive. Uber has reported significant growth as well, and ride-sharing has turned into a robust business model. Before the pandemic, I wouldn't have said that to be the case. A confluence of factors have all worked in its favor. Number one, remote working is in the rideshare favor. If you only need to go to work 1 day per week or 2 days per week, then that totally changes the equation of whether or not you want to own a car, right? If you only have to commute to work 1 or 2 days a week and you calculate the cost of ownership and the cost of transportation, it's much more in favor of using rideshare for those 1 or 2 days a week that you're going to need that ride to work. And the rest of the days per week, you don't need the car, so you don't want to own the car for that reason. Especially because the cost of vehicles has gone through the roof, essentially, right? Owning a vehicle, the price of cars has exploded. And parking is another huge inconvenience, especially for those of us or those of you that don't live in a home, that don't own your own home. You've got to pay extra for parking. And so that has changed the equation for many folks in favor of rideshare. Another thing, the price increases have worked in its favor. That allows it to leverage some of its fixed cost and allow it to increase prices on consumers and have consumers go ahead and pay them without saying, no, thank you. And then on the other side of the equation, the supply side of the equation, working as a provider of ride sharing for some people is a much more convenient job than many other types of work. You get to choose your own hours, work when you want to work, and work as a driver. Instead of someone telling you these are your hours, these are the days off you can have, this is what you have to do. As a Lyft driver or as a rideshare driver, you have more choice. And people prefer choice. And that's been working in Lyft's favor as well, as the supply of drivers has increased and to match that of the demand. So those factors have all been working in Lyft's favor. And the industry has come to a position where the company has now generated 2 consecutive quarters of free cash flow. So overall gross bookings were up 21% year over year in the most recent quarter to 3.7 billion. Revenue was up by 28% year over year to 1.3 billion. And the net loss improved to just 31.5 million compared with 187.6 million in the first quarter of 2023. Looking at total rides, those were up 23% to 188 million. And Lyft said that reflects strong demand across all use cases, whether it's early morning, commute, weekend, evening trips. All of those cases were increased for Lyft in the latest quarter. Active riders increased by 12% to 21.9 million, and that continues to grow as well, as the company, especially now, is entering a new market, and that new market is Canada. Over the past year, they've brought their focus to that market, and they've already doubled rides in that year and more than doubled new rider activations and driver hours in the first quarter. So they're making great progress in that regard. And then a new monetization opportunity for Lyft has been advertising, which revenue grew by about 250% from the same time the year before, as it seems like advertising is reaching people everywhere. You cannot avoid advertising, unfortunately. Wherever you go, advertisers want to follow you wherever you might be, and drive share or ride share seems to be the latest vertical where advertisers are finding people. Longer term, I've heard some concerns about investors in how driverless car technology will impact these rideshare companies like Uber and Lyft. And my opinion so far in my research, I found it as a neutral impact with wide disparity of outcomes. Meaning, what do I mean by wide disparity of outcomes? I mean, it can be extremely profitable for Lyft and Uber, but it can also be extremely devastating for Lyft and Uber. One of the positive cases will be that, one of the largest expenses for Lyft and Uber is the rider pay, how much they pay the drivers. And so if you have driverless car technology, you don't have to pay drivers. But you will have to pay to license the technology most likely, or you will have to pay the provider of that rideshare. And if you can pay the provider of the rideshare less than you can pay the people that are providing the drive share, it will be more profitable for you as a company because you've now lowered your cost, right? That's the scenario I think is probable because several companies around the world are investing in this driverless technology or automated driving, driverless cars, right? It's not just Tesla. Tesla's just been the most hyped and most publicized, but there are already other companies, other segments of companies that are providing driverless rides on roads today, several places around the world. So there are driverless cars right now operating around the world, not Teslas. So it's likely that several of these companies will cross the finish line and be able to offer this on a broader scale. And so because most of that investment will have been made upfront in research and development, these companies would be happy to license that technology and generate profit from the likes of Lyft and Uber and others. Or maybe those companies that develop the driverless car technology, instead of licensing out the technology, maybe they want to go to market themselves. And instead of spending the investment in marketing and trying to attract all of these customers on their own, maybe they just say, let's buy Lyft or let's buy Uber. And that way we can get access to tens of millions of customers all at once. All right. So that's why I say the impact could be positive or it could be negative. If these driverless car technologies come out and they want to go at it on their own and they don't want to license it to companies like Lyft, then Lyft will have to compete now with one of these driverless car technologies. And will they be able to compete effectively? At what price will those driverless car technologies be able to offer ride shares? Will they offer them at lower prices than Lyft? Will it be the same? So that's where the downside comes in. So longer term, I think it's neutral and with wide disparities of potential outcomes that could happen as a result of this new technology. Over the next 5 years, the investors that are following Lyft stock on Wall Street, they think its earnings per share will grow by 17% per year, each year for the next 5 years. And the stock is currently trading at a forward price to earnings of 15.49, which I think is a relatively cheap valuation to pay for this stock. So to answer the question, yes, I do think Lyft stock is a buy at current valuations. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.